Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. stock market, S&P 500 outlook, AMZN versus Google earnings, PLTR, CX, LIY. This video presents a direct informational narration of the source document. Let's jump right into this explainer. Looking at the July 31st market close, the source notes that the Russell dipped while tech broadly rallied. This was highlighted by a massive 15% surge for Amazon, which kind of mirrored Microsoft's earlier gains, especially as Google recovered some of its own post-earnings losses.
But it wasn't exactly green across the board. The materials sector actually led a broader market decline, and the memory sector took a really notable hit. The source document shows that despite opening high, memory stocks closed substantially lower. We're talking Micron dropping 6% and Western Digital falling 5%. So what was the culprit here? Basically, a ripple effect from the Japanese chipmaker Kioxia after their earnings and forward guidance completely missed expectations.
Moving on, here is our agenda for this explainer. We're going to cover consumer sentiment and inflation data, hit the July market summary, dive into big tech AI earnings, review specific stocks like Kex, Eli Lilly, and Palantir, and finally wrap up with broad market technicals.
All right, Section 1, Consumer Sentiment and Inflation Data. Let's dig into these July insights.
Now you might be wondering, how are everyday folks feeling? Well, overall consumer sentiment actually beat expectations, rising to 55.2 from June's 49.5. Both current economic conditions and future expectations climbed higher. But here's what really matters for the Fed. The one-year inflation expectation dropped to 4.2%, right on target, while the five-year outlook held totally steady at 3.3%. This is a big deal because consumers are clearly feeling a bit better, and those inflation fears are cooling off, which gives the broader market some much-needed breathing room.
Next up, Section 2, our July market summary. And wow, what a turbulent month it was.
On paper, you might think the S&P 500 looked perfectly quiet in July, closing nearly flat with just a tiny 0.13% decline. But hey, don't let that headline number fool you. Underneath that surface-level calm, the Nasdaq actually suffered its worst July in 2 years. And to top it off, bond yields saw their largest upward jump since July 2005. To put that into perspective, that is a massive underlying shift.
A Goldman Sachs analyst quoted in the source document honestly hit the nail on the head, describing the July market as, quote, like a washing machine, calm on the outside, tumbling inside. It's literally the perfect metaphor for a market masking some pretty severe underlying rotation and volatility.
All right, Section 3, Big Tech AI Earnings. Let's get into the nitty-gritty of their data center monetization.
So Microsoft, Amazon, and Google all posted really robust results. This brought a huge sigh of relief to the market, confirming that AI momentum and data center spending are undeniably strong right now. These giants aren't cutting back at all. They're maintaining or even boosting their capital expenditures. That essentially puts a solid floor of support under the entire semiconductor sector.
But this brings up a really critical question from the source document. If both Amazon and Google reported rapid cloud growth, why did Amazon's stock absolutely soar while Google stumbled initially?
Well, it all comes down to a clear return on investment. Amazon proved they're already cashing in, boasting a $25 billion run rate for their AI and custom chips with triple-digit growth. Plus, they explicitly noted capacity shortages, meaning demand is actually outstripping supply. Google, on the other hand, their AI usage is mostly internal right now, optimizing search and ads, rather than driving direct external cloud billing. And on top of that, Google's higher percentage growth rate is partly just a mathematical quirk because they're starting from a lower baseline compared to Amazon's massive cloud infrastructure.
Then we have Meta. The source document points out that following a second quarter double miss on both revenue and earnings per share guidance, they're effectively stuck in a holding pattern. It suggests it will likely take until their Q4 earnings or even the 2027 guidance release for Meta to actually prove their free cash flow is fully recovering.
Moving right along to Section 4, Stock Reviews. We're going to check out the technical setups for CX, Eli Lilly, and Palantir.
Starting off with CX, the source notes their forward valuation was looking a bit stretched out as they enter their new fiscal year. The technicals suggest buyers might want to wait for lower moving average support to find a more reasonable entry point, unless, of course, the broader market momentum really holds up.
Now, looking at Eli Lilly, the options market is pricing in some serious action around their upcoming August 5th earnings. We are talking about an implied price movement of approximately $93, which is just under 10%, off a baseline stock price of $1,150.
So here are the key levels the source outlines for Eli Lilly. Cost basis sitting between $700 and $900 offer a wide margin of safety. Then, $1,000 acts as an aggressive buy point. On the flip side, if the momentum keeps up, $1,200 represents the near-term upside target.
For Palantir, options implied volatility heading into their earnings is sitting right at about 11%. To put that into perspective, on a $123 stock, that translates to a potential $14 swing in either direction.
And because of Palantir's sky-high valuation, the source emphasizes they absolutely must deliver strong forward guidance to avoid a sell-off. If they crush it, the post-earnings upper bound sits between $134 and $145. But if they happen to slip and the stock drops below $97, long-term growth metrics suggest that could actually be a strong fundamental value entry point.
Finally, Section 5, Broad Market Technicals. Let's check in on the QQQ and the S&P 500 based on recent price action.
Looking closely at the QQQ, the source document observes it's facing a ceiling of heavy resistance between 693 and 724. In fact, it recently opened at 693, only to get rejected all the way down to 680. That really indicates a lack of confidence right now from the bulls to push through that established resistance.
Meanwhile, the S&P 500 is sitting at a really critical juncture. According to the source, a breakout above 756 signals new all-time highs and ends this pullback entirely. But if support fails and we drop below 727, that triggers a much broader downtrend.
Ultimately, the source document concludes that the market's next move hinges heavily on these upcoming tech earnings. They absolutely have to beat expectations to justify these forward valuations and lift the S&P 500's overall earnings per share estimates. So the big question is, will these mega-cap tech giants deliver the fundamental spark needed to signal entry points for the market next week and trigger a broad rally? Or is that washing machine going to spin us into a deeper correction? Think about how your portfolio is positioned for either scenario.